Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-string support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. The potentially transformative effect of AI has been a significant factor in driving up the equity markets over the last few months, and indeed continues to do so, with the US equity indices very close to their all-time highs. Before diving into our main conversation this week, therefore, which is about AI, with Ben Rogoff, the highly respected, long-serving manager of Polar Capital Technology, who's very much into every aspect of AI, I thought it might be worth just mentioning three significant developments, I think, over the last few days, all of which have some bearing on the outlook for investment trusts. The first is the agreement by Saba Capital to allow the Herald Investment Trust to continue, albeit in a much reduced form. So this is a long-running saga that has now reached its climax, with Saba signing a standstill agreement with the board of Herald and agreeing to sell their significant 30% stake in the forthcoming tender, which will also allow other shareholders to exit if they so wish, up to a certain maximum, but also allow those who want to remain to do so, not least because they may have significant capital gains tax liabilities to shield. So this actually is, I guess, the best possible outcome given the conditions laid down by both sides in this ongoing dispute. And it follows hard on the heels of the news that Saba Capital has succeeded in taking control of another investment trust, Edinburgh Worldwide, which it can now use as the vehicle for its continued operations in the UK investment trust sector. So that's item number one. Item number two is to note the fact that we've had the most significant equity issuance for some time now, well, for nearly 3 or 4 years, in the shape of a C-share issue by Seraphim Space, ticker SSIT. This is the investment trust that has interest in a lot of space companies, including those exposed to defense spending, which has been the engine behind the growth of most of its holdings. They've managed to raise more than $100 million by way of this C-share issue, which will in due course convert into additional shares in the existing Seraphim Space Trust share class. So that's a very positive sign. It shows that the UK market is beginning once again to be able to raise not insignificant sums of money from the investment trust sector after a long drought of nearly 4 years. So that's item number two. And item number three is simply to notice that the FTSE All-Share Investment Trust Index, which tracks around 170 or 180 of the investment trusts listed in the FTSE All-Share Index, has this week reached its all-time high, and has finally surpassed the previous peak in 2021. So that's partly helped by discounts coming in to an average of just over 11% today, which compares to the lowest average of around 18%, but does indicate that there is some degree of renewed demand for the sector, helped by the fact that so many trusts have taken the option to either liquidate, merge, or roll over into open-ended alternatives. So the trust world has been putting itself in order, and that is, I think, perhaps beginning to show through now in the performance of the trusts that remain. So overall, these are all positive developments in my view. And of course, you can find out all the details and all the other news from the sector by subscribing to our weekly email, The Moneymakers Circle. I'm delighted to have a return visit from Ben Rogoff, the manager of Polar Capital Technology, where he's just coming up to his 20th year involved in the management of the trust, which is quite something, Ben. I have to say, when we spoke last year, it was in May, and we just had, obviously, the tariff announcements from Trump. We'd had the DeepSeek instant headline episode of the Chinese AI tool that actually seemed to be knocking others for a while, but that passed. The share price was around £3 when we spoke, and now it's around £6. So it's actually doubled since then. So all those sort of worries that we were talking about at the time have pretty much dissipated, and no doubt there'll be others coming along behind. But I wanted to start, if I might. We talked last time a lot about where we were in the AI cycle. You said in more recently that you think we've now reached a critical waypoint, if you like, in the development of AI as technology, and that is You say we've now reached a stage where we are seeing what you call true agentic AI. So perhaps we can just start off by reminding us, how you define agentic AI and why that is significant in the cycle of AI's development as a technology.
Well, thank you. And thank you for having me back on. And I hope I was sufficiently bullish when we last spoke. Again, I can't give investment advice, but hopefully we put up a good rear guard action. What was a pretty difficult moment for markets and for AI specifically, like you say. Before we get to the agentic moment and why we think that's important or critical, really, like you say, in a very critical waypoint, it's worth maybe just quickly recapping that the last 3.5 years since the advent of generative AI, which now people really just shorthand to AI as I think they must, the story to date has really been a technology that has had great promise that we felt as investors was likely to represent the next general purpose technology. But that first 3.5 years really, it was a story. We had to tell a story. We had to find historical parallels to, I suppose, give confidence to our shareholders, ourselves sometimes during those tricky moments, that this was indeed going to pan out the way we hoped. And of course, the snapshots at any given time in those last 3 years, the AI story has been punctuated by bear cases, and the technology starts off as being pretty inferior, quite expensive, prone to error, was very much the sort of investment narrative of 3 years ago. And we had to do our best to remind people that early applications for new general purpose technologies are often lightweight and not, frankly, very interesting, much in the same way that email was, or I suppose airmail was in the case of aviation. And I think the debate shifted towards CapEx because, again, the technology wasn't necessarily there and revenues were also not there. And so you're faced with hundreds of billions of dollars being spent building infrastructure for a new technology without apparent revenues. Again, we've been pretty, I would say, stalwart and been strong in the face of that bearish narrative because we felt, again, that the tech was getting better and that the revenues would come. And again, I think you can understand why investors have defaulted to sort of bubble type narratives and because I think in the end the tech sector has delivered some phenomenal things during my time at Polar and before that still, but also it has a tendency to overpromise and underdeliver. And so just come through a pandemic period where the promise of a different type of hybrid world just sort of fell away, really, didn't it, very fast once we had vaccines and the world returned to sort of the way it was before. So I totally understand the narrative, but some very high-profile investors likening this to .com on steroids and big holes because there are no revenues. And I think that was the debate we were having. And a year ago, DeepSeek was all about commoditization. People are spending hundreds of billions building out the infrastructure and models that are at the frontier of AI development. And here comes an open source, open weight Chinese model to just remind you how silly you all are because we're about to commoditize AI. And of course, it did nothing of the sort. What DeepSeek did was remind us that we're in a race and that the runners and riders, as anyone that does the Grand National once a year will know, can change. And they have changed, haven't they? OpenAI was in the clear lead at the frontier, and today Anthropic's Claude seems to be a nose ahead, and Gemini from Google is a very competitive frontier model. And then we have a field that's rapidly trying to give chase to those leaders, open source, Chinese, some European, obviously Meta and Microsoft in there as well. So it's a complicated race that's thankfully still being run, but what DeepSeek didn't do was commoditize the value of AI. And in fact, what's actually happened, and I think what's underpinned our confidence, and I'll get to your question, in this first phase of AI, the early promise years rather than the revenue years, has been the pace of AI model improvement. And I think we've talked about this before. Humans are, myself, I suppose, included, we're not brilliant at dealing with exponentials. There are very few things in the world that are exponentials. We tend to think in linear terms. But Moore's law, which everyone knows, was a doubling of the number of transistors on a certain amount of wafer that was sort of 18 months for the same dollar amount, transformed the world in terms of silicon. And here we are looking at AI models that are improving at maybe 4 to 5 times that pace. And that's what gave us underlying confidence that the bearish narratives that naturally dominated the narrative, didn't they? The comments around AI and not being great enough was ultimately going to be resolved because models were improving. And we listened very keenly to what people at the frontier were saying. And, Sam Altman or others talking about no wall in terms of the returns to effort, the returns to capital, the returns to data and compute was still delivering, albeit maybe at a diminished pace. But what that diminished, but nonetheless continued improvement in AI models has done is get us to this point. And this point, and I think we can take a pause if you like, but this point is this idea that AI models have now become sufficiently smart that they're able to act autonomously without humans in the loop. And not in everything, of course, but in certain critical fields, particularly in coding which is really the sort of test bed, the very early market where we're seeing the most agentic, autonomous forms of AI. I think what that's done is really bring in a new phase for AI. The first phase, let's say late 22 to late 25, was the early promise. And, it's not an easy period, like I say, for people because bearish narratives dominate. The technology is inferior and expensive, and CapEx has been rising, which has been wonderful for the trust, but against a backdrop of limited revenues. And then that all changed. And why stocks have been very strong this year, despite a war in the Middle East and oil prices and what have you, is that the revenues at some of those leading frontier labs, particularly Anthropic, have gone vertical. And now we have Anthropic at $30 billion of annualized revenue run rate, which together with OpenAI has put two companies at a similar revenue profile of SAP. Again, is that enough to sufficiently justify $700 billion of CapEx? We can talk about that. But what we don't need to talk about anymore is whether or not AI is going to deliver returns. Is it going to deliver the ROI? What is the revenue here are the revenues. And if you follow those two companies alone, they ought to be by 2029, based on their forecast, a similar size to Microsoft. So we're very clearly in a second phase. Maybe I should pause at that point, but I think that that's what's got the enthusiasm again around AI stocks, is that actually the technology has now been meaningfully de-risked. We've reached a point where you can generate $50 billion of revenues, and I think that we're in that very rapid ramp now to much, much larger scale industry.
So just from a sort of technical definition point of view, there's two things about agentic AI, I guess. A, there's the capacity to do it. But secondly, you have to have the confidence of the users that it's not going to make mistakes and lead you down paths that you don't want to go down. That's the second factor, is it not, behind why people are now adopting it in a much bigger scale?
I think that what's actually happened is, and so again, there's some technical numbers that we should quickly touch on. But I think that what's happened, I like to use historical parallels to help people because myself, I'm not a programmer or I'm a tech investor. I think it is helpful to try and find parallels that maybe illuminate where we're at, because this is very deep science and there are perhaps only a few thousand people on earth that are really at the very leading edge of this industry. So the way I like to think about it is historical parallels, and the one that I've favoured in the past has been skyscrapers as a sort of way to, for a number of things, but obviously an application for steel that people hadn't anticipated, and how the value of land is transformed. What's very interesting about steel and skyscrapers was it allowed humans to ultimately conquer vertical height. And that may sound ridiculous, but it obviously changes the value of land profoundly. And actually very interesting that in 1910, there were skyscrapers that had been developed 13 years earlier that were ripped down because you could now build a skyscraper that was twice as tall. And the economics of doing that was compelling. I think that we're looking at now an AI that's conquering cognitive depth in a way that I'm not sure that people have really grasped. And the best way to think about that is if you look at the time horizon that AI can complete software tasks and be right 50% of the time. This is just as a measure, as a benchmark. If you went back to GPT 3.5, aka ChatGPT, that tool, that model was able to do something like 35 seconds of equivalent human work. It was a phenomenal thing that you could ask a question and it would give you an answer immediately, but often wrong. But the duration of a human task that it could achieve with 50% success was only 35 seconds. If you look at some of the latest models from Anthropic particularly, we're at 14 or 15 hours. The duration of these tasks means that the work that they can be trusted with is profoundly different value. The type of things that we're using AI for internally at Polar has gone from being a quick question around where is something located or what is the forward PE or what might, just a simple point-to-point question, is now find me 5 interesting chemical companies that might be pulled into the AI trade in X, Y, or Z scenario. That's the work that a junior analyst would have taken a week or a month to do, can now be done in seconds or minutes using AI. And of course, that has incredible value associated with it in a world where we're, as a team, looking after more than $20 billion of client money. So I think that's a real example of what's happened here. Again, this happened towards the end of 2025, the beginning of 2026, and it's gone vertical. So the amount of time that it took for those task horizons to double was once 7 months. We're now at 3 months. And part of that acceleration, again, this is completely at odds with the idea a year ago or even beyond that we were going to reach upper limits of what AI models could do. They were probabilistic, and the benefits, as I say, to scale were slowing. And yet it would appear to be the opposite, where models are becoming better and the iterations, the time between them are shortening. And I think there's some recursive stuff here where the models are so good that they're able to now write code without humans in the loop. They're able to not just help coders, they're actually writing complete lines of code. Something like 4% of all commits to GitHub, which is a big software repository, are now being done without humans in the loop. So again, I don't know how deep you want to go into this, but this is not just about coding. Coding is the proving ground for AI capability because code either runs or it doesn't run. It has incredibly brutal short feedback loops in a way that writing an essay does not, or doing drug discovery does not. But in the world of coding, code either runs or it doesn't. And some of the comments from people like Anthropic, where 70% of the code is now being written and committed by their own models, speaks to something very meaningful. It's obviously created a very difficult backdrop for companies on the other side of this trade. We can come back to disruption in a minute if we may, but what this has done to software stocks has been pretty awful. But let's come back to that. The other point, if I may just share, the reason that we're so excited about the coding breakthrough isn't in and itself around code. We had this really interesting period where we went from models that had either been trained or not trained with the answer and therefore were prone to error, to models that were able to understand a prompt, break it down into smaller component parts, and then answer the question in a much better way. Reasoning models. That was a very big moment for the industry, let's say 18 months ago. The agentic moment isn't just that I'm able to ask AI to do work without me or for me and complete work. The reason it's able to do that is because the models have reached sufficient scale or sophistication or whatever word you want to apply, that they're now able to call tools, deploy tools in a way that humans are. And if you thought about the ascent of man and Bronowski or something, this is the moment where humans realize that with tools, they're much more capable than they were without tools or using their hands. So now AI models are able to call tools. And one of the things that they're able to do now is call Python. So Python is a programming language. It's not probabilistic, it's deterministic. And so, for example, it's one of my favorite parallels. I've used ChatGPT in the past to, guesstimate my wife's tax return. And it's a pretty simple return, so you can use ChatGPT. And the challenge with using a probabilistic large language model is that it might give you a different answer in the afternoon. It's not in the business of maths, it's in the business of synthesis and probabilistic, anticipating the next word. And so the work that models had been doing was all of that synthesis and remembering tax codes, but also having to do the maths was all being done in what we call token space. Now, models are able to do the synthesis. They've read everything from HMRC, so they are as good on the knowledge front as any human accountant, but they're not brilliant at maths. So what they can do now instead is call up Python, run the maths in a sort of side pocket. This is quite technical, but I'll get to the punchline. They're able to offload the cognition part of the workflow, but still be able to deliver the synthesis that no human can match. And so by being able to call tools like Python, you've turned something that is inherently probabilistic into something increasingly deterministic. And now the tax return that you do in the morning and the afternoon is the same number. And I think that's one of the parts of this agentic story that maybe others have missed. It's not just about the ability to offload work. The reason that the models can do human work is because they're able to call the same tools that we as humans use. A calculator, a web browser, a mouse, an internet connection. And because of that, they're able to now do complete economically useful work in a way that just was not available a year ago. And that's why revenues at Anthropic have gone in within 4 years to $30 billion, which I don't believe any company on earth has ever done before.
Just before we move on then, what do you make of the announcement that Anthropic made about Mythos, which has obviously got a lot of headlines? This is a coding thing that they say is too dangerous to be let loose for anybody other than a select number of companies. Is that the right interpretation of that? And how does that fit into what you've just been saying?
I mean, there's always a healthy conspiracy theory out there if you want to look for one. And there's people out there saying it's the best marketing campaign on earth. We've created something that's so good we can't sell it to you. It would make Remington look like a terrible advertising campaign in hindsight. But I'm inclined to give the company the benefit of the doubt. I think their CEO has spoken well and loudly about AI risk. And I think that we should give them absolutely the benefit of the doubt that what they're telling you is true. And I think it speaks to, like I said, a very rapid pace of AI improvement. Human beings are, this is not my theory, but I'm repeating coffee table philosophy here for you, but human beings are notoriously poor at understanding incremental intelligence. When you have ChatGPT and then you have, version 4, version 4.5, it's very hard for humans to be able to determine the improvements that are being made. And I think from a distance, it does create this really interesting sort of mismatch between what people think the capabilities of AI are and what they are actually capable of. And I think that it's very possible that Mythos has identified a whole bunch of backdoors or AI coding holes that need to be resolved in some critical applications because, like we've said, AI can do synthesis much, much better. If you're looking at code bases, of course AI can find stuff that maybe humans have missed, or that human-generated software that in the end is sort of algorithmic may have missed. And I think it does speak to the need to sort of coordinate. And it does also speak to one of the upside risks that we've been pretty consistent about, which is that there is always a chance that AI becomes too powerful to be solely in the hands of companies, enterprises. I don't think we're there yet. And if I really believe that that was a risk that we should be worried about, I would have a very different portfolio today. I just think you're getting a sort of sneak preview about just how powerful AI has become. And a debate that we would have had 2 years ago, 3 years ago would have been, how fast are we going to get to AGI, artificial general intelligence or super intelligence? These were the debates people were having. You may have noticed no one really cares anymore. They were the debates that mattered when the technology itself wasn't economically useful. But now we're moving to a world where it's already economically useful. You can imagine worlds, and again, we try to interpolate, because right now, what's so fascinating about the first 3.5 years of investing in this AI story or this AI cycle has been that at any point in time, the investment narrative would have maybe prevented you from being invested. And of course, what the present does is it provides us with guardrails, important guardrails to understand where the debates are, but they also restrain you. They don't ever really allow you to think outside the box about what happens when this technology is 5 times better in a year's time, or 25 times better in 2 years' time. And I think that Mythos is an indicator of scaling, and it's also an indicator of what non-human scaling looks like in this. You can call it the cognition era, call it what you like. But we're going to apply intelligence to things that we never did before because it was either impossible to or economically unviable to. And we're going to have a volume explosion. And one of the manifestations of that is that there will be more bad actors looking to exploit more digital holes or vulnerabilities. And we're going to need defenses against that. In and itself, I think it just speaks to a very exciting moment. Sorry, I also lost my train of thought there, which was to say, you start thinking about what the opportunity sets are for this technology. Again, we're generating code at the most incredible rate, undermining a lot of the value of existing code. But I mean, how big could this market be? And you start thinking, well, the world spends $60 trillion on OPEX. It spends $40 trillion on global labor. And we're spending meaningfully less than $1 trillion on CapEx. So that gives you a sense of the potential, what happens when we start to apply AI to some of the things that we use, again, labor and other OPEX items. Think about time savings. If we can arbitrage time. I remember Jeff Bezos wrote this incredible letter one year where he explained that the core proposition of Amazon was not to save people money because of lower prices, it was to save people time. You didn't need to go to shops. And actually, certainly for me, that's been exactly right. That I'm much less price sensitive on items. It's much more about having them delivered the next day and not wanting to spend half of my or a quarter of my weekend buying things. If you applied a similar time saving, I think 80% time saving is how he described it. And Amazon Prime was trying to capture 10% of the value. If you think that we have a $23 trillion wage bill in the Western world, 50% addressable by AI, you're talking about $1 trillion market. So what's so fascinating about Mythos, but also just agentic and non-human scaling of AI and the application of cognition in a non-human way, is you start opening the door to some hundreds of billions, possibly trillions of revenues. And all of a sudden, the debate around sustainability of CapEx and what are these companies doing seems to sort of melt away.
Both OpenAI and Anthropic are talking about having huge IPOs coming up. I'd be interested to know when you think they might happen and what the scale of them might be. They will be very hyped. That seems pretty clear. You'll then have to decide whether to put them in your portfolio, right? Well, you have no choice, really. What are your thoughts about that?
Well, they're both extremely exciting businesses at the forefront of probably the most important technology theme of our lifetimes. So if they file to come public, we would go into both companies excited and with a bias to invest. Our view is that to the victor the spoils, that today 96% of AI revenues go to the frontier labs with the best models. So DeepSeek may well have a competitive model to do X, Y, and Z, but if it can't do the agentic stuff, if it can't do the economically viable work, then it doesn't really matter. It's sort of moot. And so our view has been long that this is not commoditizing, that actually you need to be at the frontier with the best model. And that's why you can get to 30 billion ARR, because why would I want to use an AI model that made mistakes? You wouldn't employ a person that was error prone. Why would I do that work with a model that was cheaper but not as good? I mean, that doesn't make sense. You wouldn't build a building with inferior steel. Why would you do? So both companies are very much at the frontier, and that's why they dominate revenues. I would say that at the moment, Anthropic's positioning, the model, looks better positioned perhaps than OpenAI. What we've seen is that agentic AI, the early application seems to be enterprises. This is why this story has happened. OpenAI's brilliant model. I mean, ChatGPT, and it's opened the market. There's 950 million users or whatever it is, consumers, retail people using this product, and it's captured more than half of the market today. But now has a bit more competition for obviously Google with Gemini, which is also a fantastic model, and at the edge is Anthropic. But the real story is that agentic AI and the productivity that you can deliver with it, companies value that, which is why this is an enterprise takeoff moment. I should have said this earlier. So it also looks like the revenue trajectory at Anthropic is steeper at the moment than OpenAI, because I say the model might be slightly better right now. And the cash burn profile of Anthropic also looks better near term, at least, than OpenAI. But let's not write OpenAI off. They built this industry, and I think we're waiting for their next, what we call pre-trained model. And when they deliver that, there's absolutely no reason to believe that they wouldn't be back in at the front of the race. And I think that some of the bearish chatter around the business would just melt away. But it's been a while since they delivered a new, what we call pre-trained model. They've delivered some phenomenal models with post-training, and they're certainly competitive. We use at Polar both the enterprise ChatGPT product, and we use Claude from Anthropic and Gemini, for what it's worth. So I think we're positively inclined towards both. I think they both are very unusual assets. What we've seen over this year particularly is fear spreading in the broader market that the value of these large language models is paramount. That these are not just things that you ask questions of, but ultimately they're sort of orchestration engines. They're the brain in a new technology stack. And in that world, what does it mean to be a software company? What's the value of standalone software in a world where you have a sort of superhuman brain orchestrating everything else that you're doing as an organization? And I think we still feel very strongly that the biggest risk to just about every other part of the IT stack is that the value goes to the large language model, to the frontier, and everything else is commoditized. And if that's true, then you would expect us to be investors in both companies at IPO. In terms of timing, I think the expectations that both companies come public this year, but we'll watch and wait and hope.
Do you think, though, that ultimately there's a natural monopoly here?
That's a great question. I think that history has demonstrated that the null hypothesis as an investor should be a winner takes most. Certainly that's been true of all the large profit pools that we see today, whether it be Netflix in video streaming, or more importantly, people like Apple in smartphone, or Google in search, Amazon in retail. I think that should be one's null hypothesis. But let's see. At the moment, actually, it's quite interesting that I reference Anthropic being in front in the race, but they seem to have, I think, the very best agentic model right now in Claude, and maybe in coding, in Claude Code. But Gemini from Google seems to be probably as good in multimodality, being able to pull together images and text and also audio and make sense of that. I think Google has a fantastic position there. And I think OpenAI still has probably the best-in-class model for doing a bit of everything. So how this ultimately works out, sorry to use a Tolkien type framework, but do you have one ring that rules them all? I think probably yes, which is why many companies are spending more than $100 billion building out their AI capabilities. I think it's really fascinating because when you look at what's happening in my world, there's a vertical integration that seems to be happening in a way that we haven't really seen for a very long time. And we may have talked about this before, but it's one of the reasons why, in my humble opinion, we were pretty quick to sell software stocks a while ago. Most investors remember only a horizontal compute world where Intel makes the chips, Microsoft makes the operating system, and a whole bunch of companies sit on top of that and create sort of specific vertical software or horizontal software, but nonetheless not vertical in the sense that IBM was during the mainframe world or digital equipment was during mini computers. And actually we've sort of felt that this cycle was much more likely to be a more vertical compute, where you buy your chip, your GPU from NVIDIA, you might buy your networking from NVIDIA, various parts of the rack. The core unit of compute is the rack rather than something else. And it felt much more mainframe-like. And again, I'm not that old that I remember investing in mainframes, but I've certainly looked at the history of the mainframe cycle. And I do think that there are more characteristics today that look like that than they have done at any sort of post-Wintel PC, smartphone, internet world. So with that in mind, I think everybody understands that you can't really afford to lose this race, because just thinking about some of the comments that Reed Hastings, one of the co-founders of Netflix, made recently, like the challenge to Netflix on a, I suppose, 5 to 10 year view is that they're going to have to compete in a world of increasingly AI generated content with companies that own their own large language model, like, for example, YouTube via Google. So doesn't that potentially, and again, this is my words, not his, but doesn't that potentially put Netflix at risk? Companies that don't own their own large language model at the frontier are potentially passengers or spectators to what happens next. And the best thing that could happen for those companies is that ultimately AI commoditizes. You don't have to own your own steel if steel is a commodity. But in a world where steel is not a commodity and where access to that steel means that you either do or don't get the job to build the skyscraper, actually it can result in some very profound changes to profit pools. We weren't the first to realize this. I think it does explain why Microsoft, why Amazon, companies that don't have their own model are rapidly making deals with companies that do, OpenAI or Anthropic, but also why chip makers like NVIDIA are making investments in frontier labs like Anthropic and OpenAI, and why those companies are doing deals to try and get access to chips. The industry is verticalizing, but no one really knows who the winner is. It creates this sort of web of alliances that if you're a bear, you would say it's a house of cards. But if you're a bull like we are, you would say this is a perfectly rational way for an industry to verticalize when no one, including the very smartest people on earth, know who's going to win the race. So the cost of losing the race, and again, this is through the AI lens that we think about all the time. And the AI lens, as a reminder, is something that we added to the investment sort of process May 2023, where really the lens is there as a metaphor to make sure that anything and everything we do is considered through a world where AI is a sort of dominant general purpose technology around which everything is reimagined, which was a bit nuts 3 years ago, but doesn't seem quite so far-fetched now. And that's what's, again, enabled us to be in the CapEx beneficiary stocks. We can talk about some of those if you're interested, and also steer clear of companies that are built on code. Software companies, digital platforms, the winners of the smartphone cloud world that dominate profit pools, most of those companies don't have a large language model. So in a sense, their fortunes depend very much on stuff that's happening outside of their control. And I think that creates terminal value risk that most analysis doesn't really capture. I don't know, a booking.com, how does that stack up in a world where consumers are not the incremental buyer of a hotel room, but agents are?
We talked last May when we had the last podcast about some of the worries and things, and you said you were worried about the impact on software back then, and you've been reducing your exposure since then. That's turned out to be a good call. You said you weren't too worried about tariffs either, and that's turned out to be quite a good call as well, as it happened.
Maybe lucky on the tariff front. Genuinely, I'm so happy that we made the call. We had talked about it for sort of 2.5 years, that large language models had the potential to start sucking some of the value out of the software world. What's happened, of course, is that things have moved much faster than even bulls like ourselves have imagined. I don't think anybody was imagining that Anthropic would be at 30 billion ARR because it was at 9 billion 5 minutes ago. So that sort of inflection point has happened. And you obviously have seen certain things happen with Anthropic and plugins and the progress that these models are making. So we've had that right, I guess, and I'm really happy that we did. But I don't think it can stop there, can it?
You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. You also said last year you thought that Google was, or Alphabet that is, was not doing as well as they were, and since then you've had to change your mind about that. You've been increasing your weighting in Google because they are potentially one of the biggest losers from all this if things go against them, but they seem to be fighting back. The general theme, though, being spotting the losers is such an important part of technology investing, right? I mean, you've always made that point. That stands out from previous historical experience as well. You're talking about information companies, so I guess you're talking about things like Relics, Rightmove, and people like that. There's sort of specific stocks that could at least have faced challenges going forward.
I think that's still very true. Look, on the Google front, I mean, I think what's key is that, well, a few things. The first thing is, I think, Mag 7. We own all of the Mag 7, wonderful non-fungible assets that dominate profit pools, and each has a bull case around AI that's still alive and well. The unfortunate thing for all of them is that there's also now a bear case. A more capable AI poses risks as well as opportunities to each and every one of those companies. It manifests in free cash flow because, look at the capex burden now that companies like Amazon and Google and obviously Microsoft are having to bear to remain in the AI race. Now, again, look at the phenomenal growth that each of those companies have had in their various AI businesses. And, again, I'd much rather be in stocks that understand the opportunity and the risk posed by AI than companies that don't. but they are becoming much less asset-light businesses and much asset-heavier businesses. And I think that's sort of taken its toll on their collective attractiveness as conduits for AI. So we own them all. Right now, there's what feels like a shortage of compute. So we've been rebuilding companies like Amazon, where actually we've been reducing previously because they don't have a model of their own. And in a world where compute is increasingly driven by machines, where machines make the decision about where a workload, a unit of compute will be stood up, I think that that's quite threatening to Amazon when it has to compete with a company like Google that does have a model. So we had reduced Amazon meaningfully. Now we're in a world where it feels like there's not enough compute, and all of a sudden, actually, Amazon's cloud business could really be a beneficiary of this sort of short squeeze that's occurring. They also have chips, they have their own Trainium chips. And I think Anthropic's model has been also built around Trainium, so that's given the business a bit of a boost. Anyway, let's not get too bogged down there. I guess what I'm saying is that overall, we still feel like it's a less good conduit than it was when being in the AI race was cheaper and therefore only really represented upside optionality for those businesses. But around Google specifically, that's probably the most interesting one because obviously most of the business is built around advertising, and that's advertising for humans. So should behaviors change, should machines become the incremental consumer of everything, then you would think that advertising-based businesses were at significant risk. Where a product sits on a website is really not something of interest to an AI agent that's acting on our behalf. And that's why we are very, I don't want to say bearish, because it's like we've just chosen to sidestep businesses that aggregate other businesses, sitting as a digital layer between a physical asset owner like a hotel company and bringing that supply to an aggregated consumer has been a phenomenal thing in a world where humans have been faced with, frankly, unlimited choice and where time is valuable. I mean, let's be honest, time is valuable. Humans operate on an efficient frontier where the unit that matters is time. So an aggregator of information services is extremely valuable to a human because we value time in a way that, by the way, a machine does not. And this is why I'm very anxious about businesses that aggregate and help humans, attention-scarce humans, make decisions.
So this is your right move and your booking.com.
Yeah, I'm afraid so. Again, that doesn't mean they're bad stocks. And if you own them, I'm not giving our listeners investment advice because I just think it's easiest for me as a tech investor to just sidestep them. So, there's a bull case at Relex, there's a bull case at all of those companies that are wonderful businesses. But I think what, at the very least, you're seeing from AI is some of the bundling that companies do is being unpicked. Do I need all of your services or just the bit that's truly proprietary? And can I access some of the other stuff using Anthropic's Claude? And that's what we're doing. We're Bloomberg users, for example, but increasingly the amount of work we're doing outside of Microsoft and Bloomberg is just gone up exponentially because we're using large language models to help us with work and doing some of the things that we would have done inside of those platforms. And why would that be different for anybody else? So I feel like information services companies, the risk is more competition, lower clearing price and unbundling. Software, a lot of what software really is sort of business logic and sort of best practice. And I can do some of that stuff with large language models today. Not as well, but at much, much lower prices. And I think that extends into content creation. But I don't know how deep you want to go into this, but I think this isn't just a tech thing. Every business on earth is calibrated where the consumer or the customer is a human. But what about businesses where, I don't know, take a real world company like a hotel company, where for however long now, they've been paying away, I don't know, maybe half of their profitability on a room night to a digital aggregator or that layer that basically drives the traffic. Would I rather be the asset owner or the company that sits above the asset owner in an AI world? I think I'd rather own the asset. Just to be clear, we don't own hotel companies. We're unlikely to ever own a company that owns hotels. But if you look at the gross margin profile of PCT, it's moved from the 70s, 70% gross margins, software, internet platform heavy, into the low 50s, very high 40s. That's because this feels like a hardware cycle, and it's much harder to apply AI to creating new motherboards or the copper that you need to put on top of printed circuit boards or, I don't know, the testers that you need to test chips. You can't use AI for that. AI can't recreate atoms, but it can recreate digital code bases. So I suppose it's sort of two birds with one stone when you lean into the AI CapEx story is, not only are you getting exposure to the growth in infrastructure spending that we wanted, but you're also sidestepping at the same time the risk posed by AI to the profit pools of the past and the businesses built on digital code.
Well, I'd like to just quickly talk about your portfolio and how you've been dealing with that. I mean, obviously, the lesson I think that's come through very loud and clear in what you've been writing and the way the stock's been performing. You've really got to be pretty nimble in this game, right? Because
Yes.
things do change and you get these kind of out of the blue sudden shocks, or at least about which investors get very nervous, even if they're not right when they do that. So you've got to be pretty nimble. And if we look at the makeup of the portfolio, we talked about picks and shovels last time and the stuff that actually goes to make this all work, the infrastructure, if you like. So we're talking about chips, obviously, talking about cloud computing, talking about suppliers, talking about memory, storage, those sort of things. They dominate your portfolio, I think it's fair to say. What sort of turnover you had over the past year? You've got to be very, very fast, right?
Yes, turnover is north of 100%. It's quite an interesting concept. If I could just quickly touch on turnover, because I'm actually fascinated by this. I think you're exactly right, Jonathan. The reason that you have to be nimble is because you're in an environment where AI demand is exceeding AI supply. And that manifests as CapEx because people are trying to build models that are competitive at the frontier, but increasingly it reflects an insufficient amount of compute to allow Anthropic to grow from 30 billion to, I don't know, 150 billion or whatever the number is. Like, there's not enough compute for this. The reason for that is because the underlying compute stack for AI is a different stack. We don't have to go back through this, but I think we've talked about this before. We've likened it, Formula One cars to Toyota Priuses. With the best will in the world, you're not winning any race with a Toyota Prius. So we're building an infrastructure from scratch. And so the numbers are very large, but the starting point 3 years ago was zero. So we're now in that point where revenues are ramping and enterprise adoption is happening, in our opinion. And so demand exceeds supply. In that environment, what of course happens is bottlenecks. And bottlenecks come in various shapes and sizes. And as you know, in the real world, as everyone knows, you solve one bottleneck, you create another. So if there's not enough chips, then you can't do anything. But once you have enough chips, then you start thinking, do I have enough memory? And if I have enough memory, can I offload it to enough hard drives? And if everybody's in a race, then of course these pressures are all felt concurrently. Also, what's interesting is that there are various different formulas that the various frontier labs and the infrastructure guys, for example, Google is using its own chips. So there's bottlenecks that are created because of demand, supply, imbalances. Then there are the bottlenecks that are created because at any particular moment, one of the teams, Formula One teams, if you take the parallel, might be winning because they have the new model or because Google's new TPU, its own chip, is perhaps having more success than people anticipated. Now there's a shortage of ASIC testers or, in that particular configuration, they may be network intensive, but less memory intensive. And then OpenAI, which is very NVIDIA heavy, lands with a new model, let's say Blackwell driven, and they might use more power, but less of something else. So on top of this demand supply thing, you have a complexity that is genuinely mind boggling. We have a team of 12 at Polar. We do 1,000 company meetings a year. I would imagine that we collectively go to Taiwan and Japan more in a year than some teams have done in their lifetimes. And I say that not as a boast, but just as a backdrop for why we feel able to go after those bottlenecks. I think if you're running money with 3 people, if you're a generalist investor, if you're trying to rifle shoot in an AI story which is changing as fast as the one that I'm watching, I think it's going to be very, very difficult. And maybe what you'll end up doing is picking 2 or 3 of the big names, and you may end up with the right ones. But like we saw with Google, you can go from being a loser to a winner very fast in terms of narrative terms. And like in Meta recently, you can go from being a perceived winner to being a bit further behind than you would have liked in the AI race. Those narratives are going to swing around a lot, which means we need to be managing our risk associated with those Mag 7 names and our position sizes. But also the bottlenecks that you're excited about may change. And so, for example, power is an area that I think we have talked about before, which has become a very meaningful part of PCT. We're investors in turbine companies, we're investors in battery storage companies or in transformer businesses. Why our gross margins have been tending lower? Because we're leaning into fiber optic companies or electrical cabling companies that are going to link the grid to these data centers. So I look at the bottlenecks and just think, what a wonderful opportunity for active managers, but not active managers that are active but turn over their portfolios at 5% a year. And I've got to be careful because I don't want to sound like I'm being judgmental. While I've been the manager of PCT since 2006, our turnover has been consistently at around 100%. The reason for that is because, like we've said earlier, you can't miss the big winners and you mustn't carry the losers. If you do either of those things, you end up with a very different return profile to the one that you should have as a tech investor. So we're paranoid, we're FOMO, we screen for things that we've missed and we don't know why. We're not sure at any given moment that we have the best portfolio. We're paranoid that we're missing things, and why is it that we're missing things? And so we work exceptionally hard to not miss them. So we have an investment process that's built for activity. So when you have a scenario like this, where the race itself is being run at a pace that no one's really experienced as an investor, where the runners and riders are changing and the positions are changing at an incredible rate. I mean, OpenAI is winning easy and now has 2 genuine competitors at the frontier. That's new news. And the complexity of these products is changing. And is it going to be SRAM, DRAM, HBM? Is it going to be hard drive? This is right up our street, I think, would be the punchline. And so I think you have to be active. And you have to be active, willing to take significant bets against benchmarks and peers, but do it in a way that is light touch. Understand that the bottleneck that you're excited by may close, may be resolved, and then it will be time to move on to another bottleneck. And the only way you can possibly hope to do that is if you have an investment approach that's, as I say, light touch and sort of paranoid, and built on top of, as I say, 1,000 company meetings that we're doing collectively.
And part of that means, I mean, I think you say this explicitly, a lot of people go on about valuations across the whole space, if you like. But I think what you're saying is you have to pay up for the ones who are going to be exploiting these bottlenecks or winning this relative AI race. Is that right? In other words, you're paying a higher margin, a higher PE or whatever valuation metric you use. You're prepared to pay for that.
I mean, just stepping back, I mean, if I look at the overall portfolio, if you looked at the PE median on 2027, and these are our numbers, so please take them with a pinch of salt, they're not externally blessed. But I mean, the portfolio is trading on about 25 times median PE. And obviously there'll be names in there that are meaningfully cheaper, and there are names that, and again, that's not a weighted number, that's a median. That's not like 100 times in the dot-com period, or 60 times, or 80 times, it's 25 times. And yes, the index is trading on more like 18 times. So it's a healthy premium. But if you went back to, I suppose, all the conversations that you and I have ever had, we would have probably told you that we were trying to put together a portfolio that delivered 30 to 50% more growth for a similar amount of premium. And you're trying to basically deliver a portfolio that gives you more growth for a modest premium, and over time that should manifest as outperformance. That's been sort of the mantra of the post-Brian Ashford Russell world, at least at PCT. And if you look at where we are today, our portfolio, actually the EV sales metrics are now below the index, but that's because our gross margin profile is lower. So let's forget EV sales. In the old days, we used to give you EV sales because companies that are in their rapid growth phases are very poorly modeled. So we were using EV sales as a sort of forward indicator for price earnings later. Discuss. But that's what we used to talk about. Now we can talk about PEs and earnings growth because we're investing in companies that have earnings right now. And we still feel like many of those companies are mismodeled, because no one really enjoys building models where companies grow 30%, 30%, 30%. There's always fades in everything. And if you look at growth forecasts for NVIDIA, there's an incredible fade. If you believe that OpenAI and Anthropic are going to make the revenue numbers that they claim to be making, then we suspect that NVIDIA is very mismodeled. But at face value, this portfolio trades on 25 times median PE versus 18. But in exchange, the portfolio is expected to deliver 27-ish% earnings growth this year and next, and the index is expected to deliver 18. So it's sort of completely consistent with what we've always done. So I don't think we're gravitating necessarily towards the more expensive names, but what I have been consistent about is that the first thing we do as a team is to try to identify the assets we want to own. And the second thing we do is consider the valuation of those assets. And I think an awful lot of people do it the other way around. They screen for valuations and then work out what it is that they can afford. What's actually happened, of course, at these companies is that many of the companies like Seagate, think of some of the more prosaic names, not just the absolute humdingers in NVIDIA and others, is that the company's earnings have just been completely transformed by AI. And if you look at what's true of many of our holdings are industries that have had almost no purpose in a post-dot-com world. They've been commodity inputs in a cloud world that no one's really cared about, because it's all been about efficiency and doing compute as cheaply, as utility-like as possible. The mass production of compute is how we described it. And meanwhile, what's happened is industries have consolidated. So there are really only 2.5 hard drive companies left, and there are really only 3 and a bit DRAM and NAND flash, maybe a few more memory companies left. They've all consolidated. If you look at all of that post-dot-com, the JDS Uniphase generation of companies, there's really only about 3 left. And of course, they're now to the victor the spoils. And so, yes, valuations of those assets are now meaningfully higher than they were 3 years ago. But I'm not sure, they still look completely reasonable, in our opinion, relative to what their growth trajectories look like for the next few years. So it's not that we're agnostic to valuation. It's just that we want to assemble a portfolio that can deliver more growth in the index at a not unreasonable price, and accept that we will make mistakes, which is why in PCT we still have 90 odd stocks. But those 90 odd stocks, let's say 2/3 of the exposure is very much still driven by CapEx beneficiaries. We're looking actively for companies that are going to be not infrastructure winners, but actual application beneficiaries, but they're really quite hard to find. And on the whole, early candidates have disappointed, haven't they? I mean, software companies were supposed to be the beneficiary layer of AI, and at the moment they look like they're on the wrong side of the trade. So we're treading carefully on the beneficiary story. We have an AI fund, which I know we're not here to talk about, which has also performed very well. And there we are finding companies in the real world that we think are genuine beneficiaries of economically capable, viable AI. But we're not here to talk about that fund, and I'll focus my attention on PCT. So we're in earnings season right now. We've got a lot of companies reporting. So I think it's fair to say that at the margin we've been taking a few profits. Not all, but some of our best performers recently. One never knows where expectations are when you run into earnings. We're not making any significant changes to the portfolio shape. We're still very much pro-AI. We're still very much of the view that the value of AI at this point is increasingly accruing to the companies with the models at the frontier. And that should set us up for more of the same. Beneficiary trades, lots of disruption happening both within tech and outside of tech. And disruption that I think is still being sort of not very well understood. Disruption for you, but not for me, seems to be the prevailing narrative in the market. And you're smiling, but I think that, when you talk to companies, it's always other companies that are being disrupted by AI, but I'll be fine, Jack. And our view is very much that there may have been some canals that did fine at the time of railroads, but as a group, canal companies didn't do great. And the same would have been true for ships at the time of aviation, and the same would have been true for iron companies at the time of steel. Like our null hypothesis is that if you're on the wrong side of the trade, you're best sidestepped. And we can always revisit. And the scenario that's required for us to come back to those companies is the AI progress, which for us is the absolute kernel of our story. AI model progress. It's AI model progress that's opened agentic, and it's AI model progress that's going to open up these enormous invisible markets that we cannot know what they are today, but are likely to comprise things like R&D in drug discovery or what have the very, very largest market opportunities that today remain elusive, but with further AI progress become visible.
Okay, so I got two more very quick questions, and then we've completed our allotted time. First question is, we obviously know that these technology cycles in terms of markets are very volatile. You've mentioned that yourself, and that affects you directly. I mean, looking back over the last 5-12-month periods, I was doing that this morning. You've got plus 100% one year, plus 50% another year, flat another year, minus 10 one year, that sort of thing.
Yes.
That's the nature of the game. You've had a very strong 12 months. You're outperforming the benchmark. You're doing very well. There's bound to be more ups and downs along the way.
Yes.
Right?
I think it's a really important point, and I'm pleased you brought it up. I'm typically, and I try to myself, which is to remind people that the tech story, I mean, one of the best decisions of my life was to become a tech investor. And, I was actually offered at my first buy-side job, do you want to do tech or financial? So I got that one right. But that was a long time ago now. Since then, obviously, tech has delivered fabulous returns to the long-term investor, but subject to some incredible swings. And I think we remind people that, firstly, obviously trees don't grow to the sky and all of that stuff. But I think more importantly, the best parallel for where we are today, in our opinion, has been for a while the dot-com infrastructure build. Now, dot-com ended badly. There's a good chance that the AI story at some point will end badly, because obviously you're adding large amounts of capacity, and at some point there'll be too much. And civilization will be the great winner from that when AI is priced at zero and we can apply cognition to everything. But let's hope we've got a good few years before we get there. I suspect we do. We're only in year 3.5 of this infrastructure bill. Anyway, let's go back to the 90s, which also was inherently more speculative because we had deregulation and we had Y2K. We had other stuff happening at the same time as the advent of IP traffic and the internet, TCP/IP and the browser. Go back to 94, 95, 94 through 98. You know this stat, we've said it a number of times. The NASDAQ goes up 3.5 times, but it also has 15% corrections 7 times. And they're pretty painful drawdowns. So again, I think what we're trying to say is not that we're going to deliver you 3 times your money or anything like that. Again, I can't give you advice, but what I can remind you is that even against a backdrop of phenomenal returns, you'll be tested, will be tested. The portfolio will be tested by either micro things or macro things in the case of tariffs, or DeepSeek in the case of technology things. And everyone, all of our holders should be aware that, and particularly it's going to be more true as you extend through the cycle, that some of these drawdowns, and I think it was true if you go back to that 90s period, where the drawdowns in 97 and 98 were more testing than the earlier ones. Interestingly, I think that's a function of just prices and gains, and perhaps assets become slightly less good quality as the cycle extends. We haven't had that yet. We have barely had a single IPO that's an AI story come public yet. And when I think about, Anthropic and OpenAI potentially IPOing and also SpaceX, loads of people ask us, does that mean it's the end of the story? But let's not forget that Yahoo came public, I think, 96 or something, and eBay 98. And these were very real companies. They weren't the speculative end of the IPO spectrum. They were real businesses, and they performed very well post-IPO, actually, when they came public. So, look, I think what's really interesting from our perspective is the technology appears to now be de-risked. The story around AI isn't good enough, it's never going to be good enough. Like, that's just been, I think, disproven by the fact that you have 30 billion of ARR at one company. The tech, I think, has now been de-risked. But obviously, the risks change, don't they? They change from being around the technology and is it real to what's priced, where are the bottlenecks, could there be an air pocket, what happens if someone drops out the race? There's always a risk to your story. And I just think it's worth reminding people of that, and that even though the tech is de-risked, I would have thought that the drawdowns could be more challenging as we extend through the remainder of this cycle, but we still remain very constructive about the return profile of the trust.
So just going to add to that, I mean, the question I won't have time to ask you is about how your AI-induced recovery plan for Man United is going, because that was something we talked about last time. Yeah. But I just wanted to ask you about the trust and the fact that you've had this incredible year with sort of growth numbers that other people would die for, and yet the trust still trades at an 8% discount and you're buying back shares. So what's going on there? Is that a function of the perception of risk, or is it something that is germane to some other factor that we haven't talked about?
Yeah, I think that it seems to be an industry-wide phenomena that discounts are prevailing, and all you can do is play the cards you're dealt. I think the company's been absolutely on the front foot and buying back stock. I think we've reduced the share count by 5-ish% over the year. I think that's probably not an unreasonable number to be thinking about going forwards as long as this discount persists. I think that, again, it's slightly frustrating because the return profile has been great. I think that, when you look at flows into the overall closed-end industry, but also just UK equity full stop, they've been very difficult, haven't they? And I think we're part of that process. If you look at flows into our other products, the open-ended fund, we have an AI fund that recently got to 3 billion in size, which we're really happy with that. And I think our holders are very happy with the return so far to that product, but also our open-ended tech fund. We have begun to see positive flows again. So I'm hopeful, I'm hopeful that the discounts, when they have been closing, haven't they? We were at more like, 10 or 11 or maybe wider. And now we're sort of consistently at 7 or 8. And there's no reason why that discount needs to persist. I think that when you've had a really strong run like this, it's difficult, isn't it, for people that aren't in the trade? For those that are in the trade, the temptation, understandable temptation to take profits is really high. And again, I can't give advice, but you can totally understand why people might want to take profits after such a strong run. At the same time, this is such a great story. The AI story is sort of 3.5 years into something that I really do believe strongly has got years to run. But if you're not in this, you will have felt like you've missed it. And if you are in it, the temptation to take profits is there, isn't it? So I think what all of that says to me is that the discount where it is today is another reminder that there's a fair amount of skepticism still around the AI story. I really do believe that. And the overarching narrative that we're now going out to investors is that actually the first phase of early promise is sort of done. We sort of bookended that. Now, this should be the best bit where it's very hard to model these companies. You've no idea where revenues are going, but the upside potential is vast. And as long as AI models improve at the cadence or similar to what we've seen in the past, we're going to be consistently surprised to the upside by what AI can do and the new market opportunities. So look, I feel like the discount to some degree reflects a sort of malaise in investment trusts, which is sad actually and unwarranted. And the company continues to buy back stock as a salve to that. It's obviously accretive for us to do so and great for long-term investors. If you think about what that accretion has done relative to the fees that people are paying, it might have covered half of the costs. So that in itself for a long-term investor is something worth considering. That the actual costs of owning PCT are less than the sticker price because the company is buying back, at the moment at least, 5-ish% of a company at the 7 or 8. That's 40 bips of accretion, isn't it? So that's something to be said. And maybe as we go through this cycle, as some of that bearish narrative and the fear that one doesn't want to look see being late to a story gives way to much more enthusiasm around AI and more retail ownership and more excitement, probably at the point where we should all be doing something else or taking some profits more broadly, maybe the discounts will come in there. I actually think that they reflect, UK equities the investment trust challenges or the lack of what appears to be an incremental buyer, and this sort of unfortunate crossroads of if you're in the story, the temptation to profits is quite high, and if you're not, you feel like you've missed it. And then this final bit, which is actually there's still a lot of skepticism. And it's worth reminding people that PCT was trading on a persistent premium for the last 12, 18 months of the .com period. So I don't feel there's any reason why we couldn't be back at par, but let's wait and see.
Well, thank you, therefore, Ben, for taking all this time. I will allow you to say one thing about Man United, if you like, which is that they're back up to third now, and you think next season they'll be champions, will they?
Well, I don't know, but if they've been using the same AI that we talked about, that might explain this remarkable recovery. For the record, I'm a Charlton fan, and our miracle was surviving a season in the Championship. So you may not be expecting a tech investor who's paranoid of missing out and absolutely driven by the desire to deliver the best results for a level of risk. I'm a Charlton fan, where the sort of MO at Charlton is survival, but there you have it. So anyway, perhaps next time we speak. My son is an Arsenal fan, so I suppose for a very brief period of time I should sort of lean into that and hope they don't fade again in the final furlong. But thank you so much for taking the time to talk to me today.
Not at all. Well, as a fellow Arsenal fan, I couldn't agree with you more about that. So thank you very much. That was Ben Rogoff, the manager of Polar Capital Technology. As always, very, very stimulating on the subject of AI. And, of course, very happily looking back on his performance over the last 12 months or so, which has been spectacular.
Thank you.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.